Hello and welcome to Sanderson TV. It's our 5th year here in 2024 and we're going to be looking at all of the key economic indicators, some tax tips and more with the great Roy Sanderson, who is to my right for the 5th year in a row. Can you believe it, Roy?
5 years goes pretty quick, doesn't it, Dave?
We're into our second presidential term. Can you believe it? We've got another term. We were here last in October 2023. It's now April 2024. Roy, how has the last few months been since we've been on air in terms of the conversations you've been having with the community? Where is the general attitude at the moment economically?
It's an interesting time, I think, for businesses. And individuals. There's tax cuts coming from July 1. Business confidence probably not as high as we would like. A lot of uncertainty, potential wars overseas as we speak right at the moment. We just don't know what's going to be next. So there's a lot of factors, external and internal in Australia, that's affecting the economy.
Let's see what the numbers say and get into some of our news headlines and look at these key economic indicators, starting with consumer confidence. Roy, this has been a hallmark of this show over the last 5 years, is watching this index. Now, we saw a decline of 2.4% in April on consumer confidence. Now, let's looking at this chart in isolation. You may be sort of thinking, okay, the last 3 months have been, okay. We saw a slight increase there in February, a decrease in March, but still higher than average. But have a look at this chart in the broader scheme of the last 10 years, consumer confidence, and you'll see that consumer confidence in the broad scheme of things is at COVID level, which is quite extraordinary. Yeah,
it's quite extraordinary that that's where we're at, back to where the confidence levels were during COVID.
So what this talks about, and for those that are joining us for the first time on Sanderson TV, this chart maps people's optimism in terms of purchasing within the next 12 months or purchasing within the next 5 years. It's a basket of indicators that are all mapped together to form the consumer confidence index. So what this is telling us is that people are not willing to part with their cash at the moment. That's broadly what it's telling us. They don't want to make big purchase decisions, and that's having an effect on confidence. One of the insights from this, Roy, that is quite staggering is that 60% of Australians would like to purchase a house within the next 5 years, which also is going to add pressure to that side of the market. So we're going to talk about housing very soon, but as part of that indicator, we know that 60% of people want to buy a house within the next 5 years, but can't pull the trigger now because we're in a cost of living crisis. We've got high interest rates. So we are in quite a unique situation in that sense, that we've got a lot of pent-up demand for houses and low consumer confidence. Imagine what it's going to be like when consumer confidence increases.
Yes, it's going to be very interesting, especially where the housing market is right at the moment.
Business confidence is another indicator that we're going to look at on this show throughout the year. Now, you can see since we were here last, business confidence has sort of flatlined out. As you mentioned, Roy, interestingly, during this period, we have seen another outbreak of war overseas, which has been traditionally a big factor in deciding business confidence. I think it's a rather stark portrayal of where we're at now, that even a war is, and the destabilising effect that war can have, is actually now almost factored into the market, if you like. Businesses have learned to adapt to such shaky conditions that confidence is sort of flatlined even during the outbreak of an overseas war.
Yes, very true. And when we were here last in October, that business confidence was in the negative, and it has bounced into very small positives, but still positive. So that's good, I think, for the market.
Talking of small positives, GDP growth is also experiencing some small positives at the moment. Those numbers, again, in terms of how they look in the broader schemes, they're low. We're used to enjoying high growth. The government's target for growth is 3 to 4%. At the moment, we're seeing a GDP growth rate of well less than 1%, just above 0%, but it is growth all the same. And We talked about a lot over last year, the potential pathway for soft landing, and it looks like Australia has navigated that in terms of managing high inflation and high interest rates and still maintaining GDP growth without going into negative growth and subsequently recession.
And interestingly, in a moment, we're going to be looking at immigration numbers. And although they are putting pressure on house prices, arguably we wouldn't have GDP growth if we didn't have such high immigration numbers. And that's the fine balancing act, isn't it, for the government? Absolutely.
And I think that's a good time to look back on what we said last year towards the end of 2023. We made some predictions, Roy. Here's what some of those predictions are.
Yes, house prices, rents up, immigration too high, no more interest rate rises, inflation under control, stock market to go through the roof. That was a pretty bold comment. And unemployment 3.5 to 3.7. Let's see how we did.
Well, let's start with unemployment. And you can see here that unemployment, bang, 3.7. So that's a tick. And again, this chart looks at the last 12 months, but this is at a quite low historical level. This is 3.7 is historically quite low in the scheme of things. So that's a tick for the predictions. Inflation rate, the monthly CPI indicator, and all of the measures of inflation look like they're on a downward trend, Roy.
Yeah, and they're 4.1% at the moment. So the expectation is that they'll continue on a downward trend. Although recently, in the last week or so, inflation in the US went up unexpectedly.
So one of the news headlines out of today's show is that in the US Federal Reserve Chairman Jerome Powell last night suggested that the US are going to be likely to keep rates on hold as opposed to cut rates. They're going to take a more tentative approach to that. I think that's probably going to be the pathway that Australia goes down for the new governor of the Reserve Bank, Michelle Bullock. She's got an enormously difficult choice now. Does she push rates down and risk further inflation and also risk triggering what could be the next housing crisis? Or does she leave rates on hold at a high level and prolong a cost of living crisis that's affecting so many?
And also, if she lowers rates, that will have a negative effect on our exchange rate with the US, which will have an impact of pushing up prices. So again, I think that at the Reserve Bank, my prediction is that we won't see a move until near the end of this year, if at all.
Yeah, so most economists predicting 2 rate cuts this year in 2024, but perhaps off the back of what happened in the US, we may see an amended outlook on that front. Roy, the stock market, you predicted some steady increases. You were well on your way there for a bit, but...
Well, I did say 12 to 15% throughout this year, and I just about nailed it. As at 6 months, this is 2 days ago, we were at 13% for 6 months. Now, that was quite surprising, but we've had a little correction, maybe one that we needed to have. The last 2 days has seen a drop, and that's the second arrow on the far right top corner. And in 1 day, on the 16th of the 4th, we dropped 1.81%. I suspect today, being a Wednesday, we'll have another drop because the US dropped overnight. So the stock market is on the way to have a very, very good year. The reason for that forecast is that we've had 2 very ordinary years where they've been break even, and history shows we always have a very good year just after we've had a bad year.
Okay, this is the topic, Roy, that is front and centre of government attention. It's the topic that I think will likely be debated the heaviest in the lead up to the next federal election. It's going to be the topic of state elections to come. It's housing. Where does housing sit at the moment from a prices perspective, Roy?
So this graph, the third column is saying how much the property market has changed since its peak. So you can see Sydney peaked in January 22. It has since dropped 1.4%. and Melbourne peaked in March 22, and it since then has dropped 4.1%. Brisbane, Adelaide and Perth are all still at peak. So prices have come off the boil in some states, but not all states.
And how's that affecting rent?
Well, the rent market has gone through the roof, with Melbourne having a 10.9% increase. Perth, an increase that is almost times of a mining boom. So all except Hobart have had rent increases in the last 12 months. And that graph goes back to 2019. So you can see that we're at record highs as far as, or close to record highs as far as rent increases are concerned.
Rent is high. What has that done to the vacancy rate, Roy?
Well, the vacancy rate is at such a low level that is partly causing rents to increase because there's not many vacant properties. It's putting pressure on renters to try and find a property, and therefore landlords are putting up their prices.
Roy, you mentioned migration earlier. That is also another topic of discussion, particularly in the news cycle at the moment. It's quite topical. Migration's at a very high level. Can you talk us through the dilemma on migration before perhaps explaining this slide?
So the problem with migration is that we're bringing people into the country, spreading across all states. They need to have somewhere to live. That puts pressure on housing. We're not building enough properties to cope with the number of new migrants into the country with the population growth. So there is a problem at the moment with a housing crisis. I know the government are trying to do things with it, but this slide here just shows that we're over 700,000 migrants compared to just during COVID. It was about 145,000, and we're historically exceptionally high. And I know that we want to have GDP growth and we don't want to have a recession, and I think that's the reason the government are leaving this at such high levels.
It's amazing to hear that we're in a housing crisis and we've got tradie shortages as well. So some of the data suggesting that part of the reason we've got such high migration is because we've got these tradie shortages, and part of what is driving the tradie shortages is the fact that there is so much government investment in infrastructure where the rates for labour are slightly higher than residential. So again, Roy, I'm going to come on the record and say this. This housing crisis is not going to be solved with incremental government change. You cannot simply rob Peter to pay Paul and then wait for the election and then rob Paul to pay Peter back. That's how most budgetary policy works. It ebbs and flows. But this problem is not going to be solved with simple incremental budgetary policy. This needs whole of market, whole of economy, whole of community, whole of country approach to solve this, because it's a long-term problem. It's going to take decades to solve, and it's going to need a coordinated approach from private and public sector. It's going to need a coordinated approach from each of the generations as well, and it's going to need to balance a whole range of factors, not just property and prices. We're talking whole of wallet stuff, taxes, we're talking zoning, we're talking cultural. This is such a complicated problem that requires a holistic and considered solution from many, many stakeholders. Simply saying that you're going to build, 1 million houses by this stage or 2 million houses by that stage, that doesn't work if people can't actually build the houses. And that's what's happening with the federal government at the moment. They're on the record as saying that we're going to build $1.2 million of housing. And then we're having economics companies saying, well, that's great, but that's actually not physically going to be possible. So we need to stop talking about election promises and stop talking about nice buzzwords regarding the housing crisis and actually sit down and think about what the holistic considered solution looks like.
100% agree, Dave. You've nailed it. We have a significant problem. For some time now, for a number of years, we've been hammering investors. So investors are reducing, which means governments are needing to step in to build housing. And I think that that shift where we've increased policy costs, land taxes, etc., we need more investors to have more housing, and we need more labour. So you are right, it's going to be about some of the big projects that stop or finish and complete, and we don't continue with it, hold some time and move people back to the housing construction sector.
Right, let's change pace, Roy. Let's get into some tax tips, because this is where you absolutely flourish, and this is where RJ Sanderson can make a big difference. So let's kick off with a self-managed super fund tax tip, Roy.
Yes, let me just walk you through this. If you've got more than $250,000 in super combined with your partner, consider a self-managed super fund. You can top up $27,500, which means if your employer puts in, say, $20,000 a year, you've got $7,500 left. So you can put money in, get a tax deduction for it, and get a bigger refund. I've used an example there where if you contribute $10,000 to super, you get back $3,450. If you were to buy an investment property, and investors are leaving the market, so at some point we're going to have pressure on prices to go up. We're not there yet. So maybe the brave will make a choice now. But the rule of 72, if any investment or property was to increase their rate by 7.2% per year, it doubles in 10 years. And that's one way you can create wealth with tax deductions. But don't just go out and do it. Talk to an accountant and get some advice on it.
Another tax tip, Roy, relating to cryptos and the sale of cryptos. Oh, sorry, you got one more thing here on spouse contribution. Spouse
contribution. This is not often used, but if your spouse or partner is earning less than $37,000, if you throw $3,000 into their super fund as a spouse contribution, you will save $540. That's an 18% return. Now that's not too bad. So you should look at that. If you're in a relationship, look at a spouse contribution before June 30 if the income's under $37,000. It's a great return.
There you go. Now, I jumped the gun. I started reading out some of these questions because I'm so keen to get to some of our viewer questions here. The first one starts with audit insurance, Roy. Is audit insurance tax deductible? And if yes, where do I arrange audit insurance?
So individuals can't go out and get audit insurance. They actually have to do it through their accountant, because the audit insurance people, the firms, they actually approach the accounting firms so that they get a big breadth of clients. Yes, it's tax deductible. Yes, RJ Sanderson do offer audit insurance. So you just need to look out for a renewal. And if you have a basic, simple tax return, don't take out the audit insurance. But if you're maybe a tradie with kilometres or car and lots of deductions and get a refund over $5,000, I would highly recommend you take out an audit insurance.
Okay, next question has come in, and it's regarding crypto tax sales. Does the ATO know about crypto tax sales? Do I pay tax if the profits are left in my wallet, or only when I convert from crypto to dollars and transfer my bank account?
The ATO certainly know if you have crypto currency sales of any sort. Now, when money is in your wallet, and if you make a profit within that wallet, you pay tax on that profit. It doesn't matter whether you shift it off to your personal bank account or business bank account. You must pay tax on any profits for crypto, whether they stay in the wallet or you convert to your normal bank account.
I mean, that kind of makes sense now, given the fact that crypto is an accepted currency in places. So it's effectively cash in some instances.
It's your money. It's in a wallet that you own. So you're paying tax on those profits.
Right, next question that comes from our viewers. Simple one, but an interesting one. What is a reverse mortgage?
So reverse mortgage is where normally you own your house, you have low income but high assets, and you want to borrow money against your house, and you may not be working, you may be retired, but you need the income, whether it's a regular monthly income or to go on a holiday or buy a car. So we approach the bank. We borrow the money based on the security of your home, which for the sake of this discussion, it's $1 million, and you want to borrow up to $100,000. It's 10% of the value, and then they will lend you $100,000, which you can take as a lump sum or just drip feed it so you have more income. Now, if your house goes up over the next few years by more than 10%, you've recovered that anyway. You're really just borrowing the equity, which will grow over time. Very suitable for retired people with low income.
For the first time in 2024, it's time for this segment, Roy's Rage. Roy, where are we going today?
Well, this can't escape me. The vacant residential land tax, I know it's in Victoria only, but beware of all the other states, because once Victoria bring this in, I can guarantee you it's going to come in other states. So this is vacant residential land tax. If your property is rented for less than 6 months a year, such as Airbnb, I have very few clients that rent their property for more than 6 months using short-term rentals like Airbnb. Well, less than 6 months, you will pay tax at 1% in year 1, 2%, and then 3% in year 3. The exemptions are that it's rented for more than 6 months, but also you have a holiday home exemption. If you or your family, not friends, but your family, live in the property for more than 30 days throughout the whole year, then you can avoid this tax. We have a diary system that we've created for people who have holiday homes. You should use it. What I hate about this tax, it hits property investors. And the value of the tax is not like land tax, which is on the unimproved value. This tax is on the improved value, which is like the market value. And vacant land tax is on top of normal land tax. So you pay normal land tax, Dave, but you also pay this vacant land tax if it's rented for less than 6 months per year.
Yes, I think it's hard to argue that there hasn't been a series of taxes that have hit property investors, and I know it's been a particular gripe of yours. Yeah, it'll be. I think that diary will certainly help people. The 30-day holiday home thing makes it potentially achievable for some people. For others, maybe not. Maybe it means selling up and out of the market, which again has its drawbacks.
So the most common question I get in relation to the home tax, the vacant land tax and the holiday home is, how will the state government know if I'm living in the property? I'll just say I'm living in the property. But bear in mind, they have access to your water bills, your electricity bills, your e-tag and your mobile phone records. So if you say you're at that property for a weekend, but your e-tag shows that you're somewhere in a completely different region, you might have an argument on your hands to say you have doctored up a logbook or a diary as to when you were there and when you weren't. So my suggestion is, for a holiday homeowner, make sure you're there for at least 30 days throughout the year. It's just crucial. Shout
out to George Orwell and 1984. It's seeming more dystopian by the day that the government's going to be looking at your water bill and electricity bill to determine whether you've been at the holiday house or not. What a way to finish, Roy. It's EP1. It's in the can for 2024. Thanks for being on the program, as always. What do you reckon we'll be talking about in May?
No interest rate increases, worried about inflation because of what just happened in America. I reckon over the next week or two we might have some share market volatility, but I still think we'll trend up. And I'm going to make a comment about what generally happens at the end of a quarter next month, because generally the big funds with all the money go out on buying splurges because they're worried about their returns for the whole year or the quarter. So as we get close to June 30, expect we will have some increases.
And I want to talk to you about stage 3 tax cuts next time and how it affects you at home. That'll be an interesting part of the discussion. No doubt housing will be on the agenda next month as well. Thank you for watching RJ Sanderson TV, the first one for 2024. Hope you've enjoyed the show. We'll see you next time.